Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is Monday Mortgage Minute. Welcome back to a new week. We're really glad to see you. Happy Valentine's Day to all of you that love celebrating Valentine's Day. Hope you have a wonderful day. If you want the bottom line up front this week, it is this. CPI, inflation, through the roof, 7.5% annualized inflation year over year, and that's what we're going to talk about today, what that means. So, let's get into a little bit of the nitty gritty. This will be a little bit of an extended Monday Mortgage Minute, and here is what's going on. Well, last week, the core CPI number came out higher than expected. And that meant that our annualized CPI inflation number was also higher than expected. You probably saw a lot of headlines about this last week. Even coming into the weekend, I had forewarned and teased that we're going to talk about this in a little bit of detail today because 7.5% is a number we haven't seen in like 40 years. Most people won't tell you that that's because it was on the way down 40 years ago. It had actually been higher prior to this 7.5% reading we got last week. What does it mean for us today and kind of what's happening? What does this mean? This means the Fed is really in a pinch, and I'm going to tell you why. This is a little bit technical, but hang with me. I'm going to show you how some of these things that don't look like they're connected are actually second and third degree interrelated. The first thing is this. The Fed is expected to give an interest rate hike in the month of March. Now, this is their short-term interest rate. That is for car loans, lines of credit, credit cards, short-term loans like that. Now, the expectation is that that was going to be a 0.25% rate hike. Well, now because of this inflation reading, there's people and analysts and bankers saying like it's going to need to be half. So now you have a kind of a split jury, if you will. Some people are saying it should be a quarter. Some people are saying it should be a half right away. And then you're also starting to hear and see that they're going to have to do a rate hike at every meeting for the rest of the year. Now that's going to have a direct impact over the course of time. The speed isn't all baked into the market right now, but it's eventually going to happen. And we're going to have to deal with it on the business side and also on the consumer side. So what does that mean? Easily understood, it's going to mean that things are going to get more expensive in some regards, which is weird though, because the whole rate hike situation is to help tamp down inflation. That's only part of the problem. You can have a monetary policy that tamps down inflation on some things, but that does not solve a supply chain issue. So if there's scarcity on the shelves of products because of supply chain, well, then you have more dollars chasing less goods, which causes those goods to be more expensive. Law of supply and demand, right? Well, unfortunately, just because you change monetary policy, that does not necessarily address the issue of supply chain issues. Now, when you have too many dollars chasing a scarce number of goods, it's natural to expect that they're going to be more expensive, but we just don't know how long it's going to happen. Now, to compound that a little bit more, this kind of loose monetary policy we had because of the pandemic and needing to keep money flowing through the system, rates were at 0 to 0.25% for over a year now. And that has allowed a lot of, let's say, easy money to make its way into and through the financial system. So that easy money has allowed for asset prices to climb. You've seen rises to all historic highs. Over the last couple of months, you've seen historic highs in the Dow, the NASDAQ, S&P 500, the Russell 2000, individual stocks, all sorts of funds that have reached all-time highs. And some of that is believed to be because of the easy monetary policy the Fed had, allowed there to be a lot of money available to put into equities. You also have retail traders, just common day people like you and me, who, if they had received stimulus money, they put some of that money in the market, and some of them made a lot of money by doing so, and they rode that rocket up to the top. Now, if the Fed, though, cannot continue doing that, then that puts pressure on these asset classes. That puts pressure on these equities, and you're already starting to see some reaction to that. If you look at the last couple of weeks of trading data on the Dow, on the S&P 500, on the NASDAQ, on the Russell 2000, people have been selling off a little bit. They're already sensing there might be an actual issue in the function and fundamental parts of the financial system. You add to that the layer of the whole overseas conflict with Russia and Ukraine and whether we go to war or don't go to war. Typically what that means though is people look for safe havens to put their money. Even governments do this. So if there is a conflict and the United States is involved, it actually might be good for bonds. I know that sounds crazy, but people look for safe havens to park money, and they look to the United States bond market as one of those places. So it's possible that amidst all of this craziness and things that look like they're not really connected, that going to conflict would make bonds be more healthy, but avoiding conflict would make rates go higher still. It's a little bit inverted, and I understand that. It's also not all answered because there's so many factors that weigh in to whether it's going this way or be that way, which causes these kinds of conversations to be complex and detailed. And then whichever thing kind of raises its position to be the priority for which decisions were made ultimately starts paving the way for whatever that outcome is going to look like. So I know I've thrown a lot at you today, but when you start seeing things happen in the marketplace, pay cautious attention to what that means. Go to the next layer and go, okay, that happened. What does that mean? Case in point, you have a lot of companies that have been reporting their earnings from Q4 2021. Some people are being treated with great success. Example, Apple outperformed. Some people are getting clobbered, like Facebook, for example. You know, if you didn't see it, Facebook had a 25% drop in one day. Typically, a pullback in the markets would be a 20% correction. That's considered correction territory. Over whatever period of time that is, it could be months or years to go back into correction territory, a 20% correction. They have a 25% drop in one trading session, literally one trading session. And I think that that's very indicative when you look at these two household names side by side. They don't do the same thing. They are interconnected because of some rule changes Apple made that is kind of hurting Facebook a little bit, but also they're in different spaces. They do different things, and they have different visions for what the future looks like for their companies and for us as consumers. But you can see already that there is a huge polar difference to how they're being treated by traders and people that are in the markets playing with the charts on who's being rewarded and who's being, I'll say, punished in this example. And you're gonna see a lot more of this, I think. You're gonna see extreme volatility over the next couple of weeks and next several months because we actually have to address core issues in the economy with jobs, with inflation, which spills over into affordability when it comes to mortgage rates, affordability when it comes to home prices, even scarcity of homes. We've talked a lot about this, that there's less homes on the market and a lot of money chasing those homes. Well, you know, I'm not gonna say you ever run out of buyers, but the buyer pool has been consolidating for a couple of months now. House price appreciation has slowed, not stopped, and you're starting to now see the kind of perfect storm brewing where there's less homes in the market, the buyer pool is smaller, the cost of borrow has gone up, you see equities showing a little bit of slippage over here, the Fed is in a corner over here needing to make a decision, we have this tension of a potential conflict, there's a lot on the line, and that is just the breeding grounds for tons of volatility. When the core inflation came out last week, the bond market went nuts, and it went nuts in the wrong direction. Mortgage rates went up quick and very steep. There was at least a 0.5% and in some cases 0.75% rate hike for the higher, specifically because of the inflation number. And it's really important for you to know that are watching if you're looking to buy a house this year or even do your refinance. The window for refinancing just to get a lower rate may already be out of reach. I'm willing to bet it's just completely out of reach for most people unless you have something in the mid-4s or higher. But for those of you who want to take advantage of the equity gain that's happened over the last 18, 24 months, this is your time to do that cash out before we roll the dice even further and maybe see higher mortgage rates in the next couple weeks or months ahead. So if you've been thinking about, oh, should I do a cash out refinance? You need to have that conversation. I'm imploring you to have that conversation. I don't even care what your reasoning is. It could be save cash for a rainy day. It could be to pay off consumer debt and let the house equity pay for it. It could be to remodel your kitchen. It could be to add square footage, it could be to build an ADU, it could be to take $100,000, $200,000 cash for you to buy a multi-unit property or just a rental property, a vacation place, a second home. It could be for you, we even have someone right now who is going to be taking money out of their property specifically so that they can start their side business and have their seed money that basically their house is paying for. So by doing some debt consolidation and cash out together, the out-of-pocket expenses are decreasing, and all the money that they need to have as seed funds to start their side business are already there, and is actually paying less out of pocket every month to do that. So now we're getting back to that situational refinance scenarios that are really going to help people in these very volatile times coming up ahead. Those of you who are looking to purchase and you're in the purchase market, I want you to seriously start taking into consideration buying a property that might have an income element connected to it. This could be a spare room, it could be a loft, it could be a granny flat, it could be an ADU, it could be a home that has enough lot size so that an ADU could eventually be put on it. We're starting to see that the homes on the market are a lot more scarce, but the ones that are on the market that are moving quick and that are getting a little more attention are these properties that have some sort of potential income element connected to it. And this is becoming a more coveted part of real estate. There's a whole nother video I'm going to make about this coming soon. But take a look at that. Don't cast that idea aside of getting a duplex, a threeplex, even a fourplex that still qualifies as residential property. And consider that. Consider something that has an income element connected to it as part of your purchase qualification and what you're looking for out there when you're looking to buy for 2022. Thank you so much for hanging in there with me. I know we did an extended version today. I also know I threw a lot of details out there. So if you want to have an independent conversation or a private conversation with myself, any one of our loan officers, please leave us a direct message, send a comment in the box below. You can even email us and let us know what we can help you do or what thresholds you need to cross in order to win in mortgage and real estate in 2022. Thank you so much for watching. Share this video with a friend. I'm pretty sure there's not a lot of nerds like me out there talking about this stuff. So if this will help somebody else, please share this with them. Let them know what's going on and that they can ask questions, and we're happy to help them out too. Thank you so much for watching. We'll see you again next week.